This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant content in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at Boeing's plans to get more planes into the hands of airlines.
Plus, what to expect from generative AI's trillion-dollar market.
But first, it's my jam, peak oil. Peak oil demand may be later than anticipated, and the pace of the energy transition spending could falter. That's according to a new BI survey. So for more, we're welcomed by Bloomberg Intelligence Senior Energy Research Analyst Salih Yilmaz. Salih, what is the survey that you guys did, and what was your takeaway here?
Sure. So this is actually one of the surveys that we run at least once every year. And there are some recurring questions that we always like to ask in these surveys, like the one that you referred to, the peak oil demand, and a few other questions. And it's always interesting to see the answers. But to be honest, it's always interesting to see how the answers change over time. So as you alluded to, the main theme in this survey that we ran earlier this month is that there seems to be a change in sentiment, especially around oil demand and energy transition. And what we're seeing in some of the answers by these participants is that the pace of energy transition seems to be faltering, as you said. The peak oil demand may be actually coming later than anticipated. And also we had a question on EV adoption, and it seems like people think this may slow. So, if I may, I have a couple of a couple of the numbers from the survey that I'd like to run with you that I think makes this quite interesting. So, actually, only about 22% expect demand of oil to peak before 2030. So, when we ran this survey last year, our number was actually 50%. So, more than half. When we look at oil demand in the near term, 44% think that the 2023 oil demand this year will be more than 102 million barrels per day, which means that would be more than 2% growth over last year. So very strong near-term growth. And then 46% is actually forecasting the European oil majors' energy transition capex to never reach 50% of total outlay. Again, that was 46% this time. And last time when we asked, this number was only 15%. And lastly, again, on EV adoption, actually only 12% now expect electric vehicles to be 50% of global new car sales by 2030. And that number was more than 20% last time we surveyed. And finally, more than half actually don't expect EVs to be 50% of global new car sales at all until 2040. And that number was only 40% last time.
What do you think is driving this change in sentiment here? Is it political? Is it economic? What's driving it, do you think?
I think it's mainly economic and just kind of oil companies doing quite well in the last couple of years. Oil prices doing really well for these kind of oil and gas companies, the profitability being very extraordinary last year, which is, I think, giving these companies a little bit more confidence to be taking a look again in their legacy oil and gas businesses, especially after last year's energy crisis, showing the importance of energy security. And I think you kind of see this sentiment in other sectors as well. I mean, when you look at some of the bank CEOs and the comments that they're making about financing these oil and gas companies, I mean, perhaps last year or a couple of years ago, they would be a little bit more hesitant about making such comments. Right. But now they seem to be a lot more confident with that. And the oil companies themselves seem very confident that, there is an end to oil and gas and it may be near, but it may not be as near as we thought perhaps just a couple of years ago.
So I guess the question then is, are you seeing companies invest differently because of this? And I guess the best example would be to look at some European oil majors that put a lot more money into the alternative energy than the U.S. majors did. They did stuff that was sort of like an ancillary, an add-on, like carbon capture, for example.
Yeah, absolutely. And I think you're kind of seeing this kind of change and wave in sentiment in some of the, as you say, especially in some of the European oil majors, where they were some of the most ambitious companies with their decarbonization targets. But then we actually saw a couple of them, namely Shell, BP, kind of backing off a little bit, moderating some of these targets. And I think it's just for similar reasons. I mean, they're seeing and perhaps being reminded how lucrative the oil and gas business might be. And then even through times like the pandemic, kind of seeing how resilient oil demand is. And even with post-pandemic, I mean, we've been asking ourselves, okay, perhaps working from home more will mean structural demand destruction. But then we're looking at how resilient demand has been since then. And how, I mean, look at the expectations from the survey or how much demand will grow this year. And it's actually quite significant. So with all that, you can see oil majors kind of rethink their CapEx plans. And I think, and I was in ADIPEC in Abu Dhabi earlier this week, and this is what the industry leaders, this is what the CEOs are talking about as well, where they are more confident in reinvesting in the legacy businesses. Yeah. But at the same time, and especially the European oil major CEOs are saying, we are still in a good position to keep increasing the percentage of total capex that we're gearing towards the new energies, the low carbon green alternatives.
It just depends on like what that actually means now and sort of the definition and how that's evolved. Salih, thanks a lot. Salih Yilmaz, a Bloomberg Intelligence Senior Energy Research Analyst.
Let's turn now to regional banks, where loan loss pre-announcements have signaled choppy credit performance ahead. For more on what to expect, we're joined by Bloomberg Intelligence Senior U.S. Regional Banks Analyst Herman Chan. So Herman, when I look at a regional bank, how's their balance sheet? How's their capital relative to some bigger banks? Do they have the same cushion?
So basically the banks, certain banks in the Southeast have pre-announced in their earnings for the third quarter some charge-offs, so defaults on their lending based on some syndicated loans that they've syndicated out to a bunch of smaller regionals in the Southeast. And it basically revolves around one credit, a gas station operator that is pretty large down there, and it's creating some hiccups in terms of credit quality for the regional banks. And we highlight First Horizon, which is a bank based in Tennessee, that basically their loan losses, their charge-offs will go up basically 3 times versus what they've typically done in a quarter.
So if I'm a regional bank, what's my loan portfolio look like? Who are my borrowers?
Yes, so your borrowers are typically smaller middle market type companies in the region that they operate in. So think of mom and pop type commercial businesses, commercial real estate owners and operators, and also the consumer folks that are in their particular footprint. So lending to residential mortgage borrowers and the like, maybe some credit card borrowers within their depository base. So that's typically what they do.
So what happened with this one company?
So it's hard to say. We actually did look at the bankruptcy filings to dig a little deeper. And what we found is that basically the owner of the properties basically pulled the rug on this operator, and now it's in liquidation.
So is this like a trickle down of commercial real estate?
It potentially could be. I think that's a good read across, but without knowing more about the issue, it's something that none of the banks really anticipated, and with it going into liquidation, it just means that there's more losses for these companies versus a reorganization type process.
When I look at a regional bank, how are their balance sheets? How's their capital relative to some bigger banks? Do they have the same cushion? Because a lot of folks like you have been telling me that it's different this time as opposed to the great financial crisis.
Right. So capital is is something that is a bit of a moving target right now. The largest banks will need to have higher capital ratios because of some of the changes underway that the Federal Reserve has articulated. So that's something that is, and big bank CEOs like Jamie Dimon have already come out really forcefully to complain about some of the changing rules in the hopes that the other folks at the Fed will potentially add pressure to Vice Chair Barr to alleviate some of these more onerous aspects of increasing capital rules. So that's something that's happening. The regional banks also need to contend with higher capital ratios, but it's not to the same extent that the big banks are facing.
All right, Herman, thanks a lot. Bloomberg Intelligence Senior U.S. Regional Banks Analyst Herman Chan.
Coming up on the program, we'll explore the reach of generative AI through the tech sector.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
The adoption of generative artificial intelligence and large language models will ripper through every segment of the technology sector and is expected to generate $1.3 trillion in revenue by 2032. For more on what to expect over the next 10 years, we're joined by Bloomberg Intelligence Senior Technology Analyst Mandeep Singh. 2032, I don't know what I'm having for breakfast tomorrow. How do we forecast out $1.3 trillion in revenue, additional revenue by 2032 from AI?
Sure, Paul, and you're absolutely right. I think predictions are so hard to make in tech. So what we have done here is to really lay out a framework for you to think about how this technology will evolve, what sort of products will really be monetized, and really lay out our framework in a way where investors or anyone who is reading this report will be able to see our line of thinking around the evolution of Gen AI. And it's obvious that, hardware is what is everyone is focused on right now. Especially within hardware, we lay out the training element is the biggest one. But over time, cloud consumption will really take off because that's how everyone wants to consume these chips and storage and compute. And software and advertising and gaming, all these ancillary markets will start using these more and more in terms of monetizable products through 2032. So that is our framework. I think what's most interesting is the market is fixated on NVIDIA's growth rates right now, but clearly there is a big tail to this technology. And if it pans out the way we are expecting, there is a lot in terms of incremental revenue for a lot of these companies. Can
I ask a really silly question? I feel like 5 years ago, you, me, and Paul were sitting here talking about the Internet of Things and how that was going to be a bazillion-dollar industry business and it was going to change the world. Is AI like the evolution of that, or is AI now a separate thing that's bazillions of dollars that are going to change the world?
So I think that you're right, actually. The IoT forecast never really panned out to that extent, although I would say IoT is happening in the sense more and more chips are being used for all sorts of things, whether it's autos or, machinery. But coming back to Gen AI, look, I think the biggest difference...
They're not the same.
They're not the same. And the big difference here is Gen AI is all about productivity tools. What makes a knowledge worker, and it could be anybody, developer, creator, anyone, any knowledge worker, Gen AI can make that person productive. How does it do it? In the form of copilots, chatbots, more conversational interfaces. And that is our day-to-day work, right? There are so many mundane things that we don't like about our work. Well, now that Gen AI has sort of developed a model which indexes to all the open knowledge that's out there, whether it's on internet or it's publicly available through Wikipedia, Reddit, etc., it's all encapsulated in this large language model. And that is where the intelligence or the conversational nature can solve a lot of the workflows. Really, it's about offering you the right suggestion at the right point in your workflow. And that's worth a lot because it saves you the time. It avoids a lot of the frustration that we have.
Which is different than like your fridge talking to you.
No.
Right.
No.
They're different. I mean, I'm just saying, just to be clear, those are different things.
So how much, I've heard some just mega CapEx estimates, forecasts associated with AI. How much of that is incremental as opposed to maybe we're just putting a new name on it? I mean, I'm just not sure what's really incremental here.
Well, the incremental aspect is what NVIDIA has showed us. I mean, look, this company didn't have a data center business 5 years back or 7 years back, and now they are talking about a $50 billion run rate. So clearly, some of it is spending that was being done on CPUs or traditional chips that will move to accelerators. You need a lot of these accelerators because they are powerful to train machine learning type of workloads. And that is where, this market right now is supply constrained. That's why we hear a lot. Over time, those supply issues will resolve. But the revenue opportunity around software and advertising is real because the whole technology is built around, leveraging more of your preferences, finding ways to automate the workflows and driving productivity. I think that's the part that I like the most about Gen AI is it's not talking about a revolution or completely new way of doing things. It's in the existing workflows talking about incremental productivity. And whether or not it happens, whether you are extremely satisfied with the productivity it's offering or not, that's subjective, but it will definitely improve.
Which is different than like robots taking over your job or like again, like it's incremental versus a huge total labor force shift. So with that in mind, what are the milestones that we next need to watch?
Yeah, so we have laid out the catalyst to watch in our report, and one of the things that we think is worth monitoring is how the co-pilots or the chatbot revenue pans out. I mean, we've already seen Microsoft announcing co-pilots, Google announcing co-pilots. These companies have to give a disclosure around this going forward in their earnings calls. And if you see these revenue lines morphing into recurring revenue, and it's driving a lot of the top line for Microsoft, Alphabet, Amazon, then this is real. Everyone will follow. And I think we're already seeing signs of it, but we've actually laid out catalysts around things to watch in our report.
All right. You guys do have a 65-page report out on this whole AI thing. You have nice little pictures, which help me. My question is, how much of this, and when I think about the technology stack, is hardware, software, and maybe just like other?
Yeah.
And you guys kind of lay it out there. This AI thing touches everything.
I mean, some people are comparing this to an operating system. Wherein actually it's like a Windows or an iOS where once you have the foundational models, you can build a lot of the plugins or the apps on top of it. And you don't need to train the models from scratch. A lot of the companies, in fact, 5 or 6 of the companies already have foundational models. So now it's about fine-tuning the model to the use case. And that is what is needed. And I think the operating system comparison, even though it's a little far-fetched, because these foundational models can only do specific things. I mentioned Copilot, chatbot, conversational interfaces. But actually, if you think about it, it's a large variety of things that they are already offering. And over time, I think there will be more capabilities added.
How heavily CapEx is this industry when they're sort of working on this stuff? Now that some stuff is up and running.
Yeah. So for the startups, as I said, they don't need to train a model from scratch.
Right.
So they don't need to buy thousands of chips from NVIDIA. They can actually consume cloud capacity, make an API call to a foundational model, and add their domain-specific functionality, which is not CapEx heavy. So granted, the training part is very CapEx dominated. But now we are past that stage. We are more at the stage of inferencing. People are talking about using the models on your phone, on your laptops. And that is where I think now the software element kicks in, and it won't be CapEx intensive.
Where are we in, how long is a cricket game? It's not like 9 innings. We have 9 innings for baseball. I was going to ask you, what inning are we in terms of AI, but I'm not sure if you're going to get my baseball reference. So I was going to flip over to a cricket reference.
Are there innings in cricket?
Well, there are only 2 innings.
Okay, so
all right, so
are we in the first or the second? And within that,
I think we are in the very early stage of the first innings of cricket, if you want to use that analogy.
All right, our thanks to Bloomberg Intelligence Senior Technology Analyst Mandeep Singh.
great stuff. I love that. It's like second inning, third inning. Anyway, coming up in the program, will more deliveries help Boeing's equity outlook fly high?
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
The 737 MAX is the key to Boeing's turnaround. Plus, rising deliveries are really needed to improve efficiencies. So let's break it all down for a 2024 outlook for the stock. Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst George Ferguson. George, there are a lot of issues that are plaguing Boeing right now. So in order to understand the outlook, let's just outline the numerous issues.
Yeah, so I think the most important issues are going to be production at the commercial airplane business, right? And so pre-pandemic, right, we had the MAX crash, and that interrupted deliveries of the MAX. That's their most money-making airplane. And then, we went from an FAA stop on that and sort of global regulator stop on that airplane. We rolled into the pandemic, and that wasn't good for demand for aircraft deliveries. And now coming out of the pandemic, we're at the point where Boeing's delivering the MAX again, but having a heck of a time getting the supply chain to work for it so it can get rates up and get good economies of scale and generate some strong cash flow. I think that's the most important issue right now at the company, but the 787s also had some problems. FAA regulators didn't like how some of the tubes are getting mated together, and so deliveries got interrupted on that airplane as well. They're back to delivering, and on the defense side, supply chains have been a challenge, and prior to the pandemic, some big fixed cost programs that Boeing got themselves into, it looks like they've just bid too low on those fixed cost programs for things like the KC-46 tanker, Air Force One, other tankers, and that's plaguing the defense business right now.
All right, so a lot of headwinds, there are a lot of issues for management to deal with, George. Let's focus on the 737 MAX. Talk to us about the supply chain. Where are the supply chain snags, and is there a fix?
So, yes, I think there is a fix, right? I guess I'm an optimist. Maybe they've dragged on a lot longer than I think a lot in the industry thought they would drag on. One of the bigger problems is that Spirit AeroSystems, one of Boeing's most important suppliers. They supply the majority of the airframe for the 737 MAX. And I think Spirit's just had a real problem with employee turnover. They had to sort of rehire people after the pandemic, train them again. It takes a while to train, a aerospace worker. It's a highly skilled job. And so they're getting there on that. But there's been a number of problems that have come through Spirit that were even happening pre-pandemic that have been sort of plaguing Boeing's ability to increase delivery rates.
And the Spirit thing is also a problem in that, they can't let Spirit fail either. So is Boeing, on the hook to help prop up Spirit while Spirit also tries to fix the stuff that Boeing needs?
I think the easy answer to that is that Boeing has already advanced Spirit money for deliveries that they haven't received yet, and to me that's just a sign of how important they are. Yes, they can't fail. Boeing can't make the 737 MAX without them, and so I think Boeing is down at Spirit trying to help them fix the problems they've got. Spirit went and raised money, I think it was earlier this year, and it was in the 9% range. So I think the credit market's, really a little bit difficult for Spirit to be accessing. You don't want to be accessing at those rates. So you could see more, if they need cash, you could see more support by Boeing and, by the way, by Airbus.
George, is China buying Boeing aircraft?
So right now, we haven't seen a Chinese order for the 737 in a while, since the grounding. The Chinese aren't even taking deliveries of that airplane right now. If that were to start up again, that would be even a further tailwind to, we think, the recovery that's coming as Boeing increases deliveries. We think it's in the works, the Chinese deliveries. There's some inventory where Boeing's built airplanes for the Chinese, haven't delivered them yet. They were interrupted by the MAX crash, so we're watching that closely. Could be a tailwind, but I think the Boeing recovery isn't totally dependent on China taking deliveries again.
Which I don't know is a good thing or bad thing. I think you could probably make an argument like either way. What is priced in currently to Boeing?
Boeing, I think, has already got some level of the recovery priced in when you look at their PE multiples and you look at their EV to EBITDAs. On an adjusted basis, EV to EBITDA, I think for this year, something like 26 times. It probably ought to be somewhere closer to 10, 11 times where you kind of see an Airbus. So I think, the market is already pricing in some of the recovery that we're going to see in 2024. And we think that recovery is built on, Boeing should move to higher build rates on the 737 MAX, its most important airplane. Near the end of the year, this year, they want to be at 38, and then they want to get closer to 50 on that airplane by mid-decade. And that increase in those economies of scale should let them generate profits in commercial airplanes that are going to be mid-single digits-ish, and that ought to be on the way to double digits over the longer term. But that's kind of how we're thinking this plays out.
George, I'm a huge fan of the 787. What's the status of that aircraft?
Yeah, so the 787 is delivering again. Like I said, it got interrupted because they were concerned about how the fuselages were mated together. That program, I think Boeing has made some really good sales recently, some larger sales to airlines like United, and the backlog is looking pretty good. And I think that sets the stage for them to increase builds of that airplane too. They want to get back up to like a 10 or so a month. They're at mid-single digits now. They make low margins on that. Those are really close to break even. We think maybe 1 or 2% kind of margins. As they can build more volume on that program, they ought to be able to get those margins up, and it'll be a better contributor to the commercial aerospace business.
You're one of those guys who goes into a plane and the first thing you do is check what air. Yeah, Guy Johnson does that too. All right, okay. George, thanks a lot. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. Keeping with the transportation space, we want to now turn to the world's 10 largest automakers where profit paths are expected to diverge between the U.S., Europe, and China. Let's welcome Bloomberg Intelligence Autos Analyst and Director of Asia Industry Research, Steve Mann. Steve, is the profit path going to be an EV profit path for these guys?
We published a report out recently, and what it's really showing is that the profits, if you look at it regionally, U.S., Canada, EU, it's going to change direction and it's going to diverge in the next couple of years. I think China is something to pay attention to. They've been building EVs in the last few years. Their EV sales about 25% of total light vehicle sales now. That's huge compared to only 7% in the U.S. So at that scale, China is actually seeing profits coming out of EVs that you're not seeing from the U.S. and the EU. So if China's profitability has been declining for the last 7 years due to pricing, and that's about to turn around. You've seen an inflection point in profit margin in China, but then in the U.S. you're actually seeing a potential decline. You got the economy slowing down potentially, and then if you look at the shift mix to higher profit trucks and SUVs, that's about to peak. So overall, we're going to see an improvement in Chinese automaking profits, while the U.S. and EU, they're facing a lot of headwinds.
So, Steve, talk to us about maybe what you guys have learned and what we can learn about the EV transition in China. Was it a supply thing? They had lots of good stuff to buy, or was it really demand pull that kind of got you to that market share?
A number of reasons. I think the three main reasons. One, policy. I think the Chinese government is pushing for net zero. in the next few decades. So they have very attractive policy that's going to entice consumers to buy, as well as forces automakers to build. So that's how they're getting in the 25%. Secondly, you've seen a lot of startups in the China auto market, EV startups, and that's providing a lot of options for the consumers.
So I guess I wonder how long this advantage lasts, because at least in the U.S., we're doing a lot of carrots when it comes to either EV production, like the big three just got like $12 billion worth of money to be able to make EVs there. There's still the subsidies. On the flip side, Europe is looking at maybe trade restrictions or making sure that China doesn't dump their EVs into Europe. So is it going to be the smooth sailing that maybe we're used to right now?
I think U.S. and EU, my personal opinion is that they need better policies to support the automakers. We did some analysis on the profitability of building EVs in China, in U.S., and the EU, and what we found is that building EVs in China is, at break even at the moment. It's probably going to be positive in the next couple of years. Well, you don't see that in the U.S. and EU, and because of that, that's why you don't have a lot of choices for consumers. The automakers don't really want to build EVs because it's hitting their bottom line. It's cutting their cash flow. So I think policy is a major factor, at least initially, to get the industry going, to get to the scale that they can produce it profitably. And that's what China is seeing right now. They're at, again, sales of EVs is 25%. Battery EVs is 25% of annual sales. That's close to break even for the industry as a whole. It's around 25, 30, 33%.
So, Steve, I finally had to get rid of my 2014 BMW 535i with manual transmission. They don't make those anymore. So, I was looking at the new X series, and the premium they wanted for electric or even hybrid over the gasoline, the internal combustion was just so huge that they just priced me right out of the market.
Right.
Is that going to change? And is that what you're talking about, government incentives to make me buy?
Or is it going to be Elon Musk just like cutting prices until everyone can buy them?
Policy is important, but I think what we're also seeing is a trend in particularly the European automakers. They're actually shifting EV production into China because Chinese, like I said earlier, they have a very established battery supply chain. They're making batteries probably at a 20 to 25% discount. Mm-hmm. All right. And so they're actually, and a lot of the automakers are thinking about building it in China. And on top of cheaper batteries, capital investment is still relatively low in China relative to the other Western countries, and as well as labor. So with that combination, EVs can become more competitive. The risk is, for example, EU have talked about slapping tariffs on imported Chinese vehicles. So that's something we need to keep an eye out on right now.
Also, Paul, do you see that? It was a great article on Bloomberg a few months ago, I guess, that basically was like EVs are evolving so quickly in China that the one you bought a few years ago is like no longer relevant, and there was a huge graveyard of EVs that were just like abandoned.
Well, they're not even really cars anymore. They're technology platforms with four wheels. That's how I think about it.
That's a good way of thinking about that.
That is so true. So in our report, we kind of dabble into the software, the connectivity of vehicles. That's probably going to be the next, I say, profit and revenue generator, the incremental revenue and profit generator. And if you look at a lot of the people in China, and as well as the rest of the world, buying EVs are actually the younger generation. And, I think what really resonates with that group of consumer is the experience that they have in the vehicle.
Thanks so much. We really appreciate it, Steve Mann, Bloomberg Intelligence autos analyst and director of Asia Industry Research.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.